You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Welcome to the show, Bob.
Good to be with you, Jim.
You're saying people are bailing out of bonds.
Yeah, the long U.S. Treasury has really had an outstanding rally, actually since about January a year ago. And our technical work got it, and we've been long. But for the last 5 or 6 weeks, the rally has become pretty strong. And then in conjunction with the rally in European bonds, Spanish, Italian, English, and of course the German 10-year notes. They've been very, very strong in price and going down to absolutely absurd yields with like 0.35% for the German 10-year note. But at any rate, so we were talking. I've been using the term the ending action in the long U.S. Treasury, and that would apply to the long Government of Canada bonds as well. And they soared up there, and in the last week and a half, we've had upside exhaustion, very overbought, maybe as overbought as only 3 times since the bull market started, for bonds started in 1981. And then we had the stop in prices, and then the first downtick a few days ago, then we came out with a target go down to 150, 143. So, but then as I just noticed a note here this morning saying it's been the sharpest rise in yield since 2009. Well, that was a different market then, where you had the stock market crash very, very severe down to the end of 2008, and then a relief, and then severe again. So, but that one, the long bond, was the flight to quality story, whereas this one, it's been the for last year, a year or so, with the U.S. Treasury buying long-dated treasuries and also buying subprime mortgage bonds, and then that program ended in October, and overlapping with that, you had the European Central Bank talking that it was going to buy bonds, and there was some difficulty of actually implementing the buying program, which they now apparently have done, and so they've been buying. But who knows? But maybe the world was in because the ECB chairman Draghi was always promoting bonds, something awful. So, and bonds, either Europe or North America, are at unprecedented yields. It just never ever happened before. So, and I'm not at all reluctant to use the term unnatural. So, but then what you can get is that not only do you have a speculative central bank buying on speculative theories, but you also got the street has been long the bond, and of course every bond trading desk is leveraged. So they've been part of the speculation as well. So when you got enough people outside of the big players in the game, you can have technical reaction, which we're getting now, and who knows how far it can go. Now, the other thing that has come out, and we're just looking at the technicals on this, Jim, is all of a sudden they got a batch of really strong economic numbers in the U.S. with an employment number. Mind you, the head of Gallup polling a week ago did say that the economic calculation of, say, 5.5% unemployed, he just blatantly called it a lie. But nonetheless, whatever number they're using, it has been improving lately. And then you've got people buying cars like there were no tomorrow, almost like they were buying houses in 2006. So the speculation is really stretched. So here you've got, and then of course part of the latest bond rally was the crash in crude oil, which is worth mentioning. Once it started to crash, we looked at previous ones, and typically they can run for 6 or 7 months, and January counted out to month 7, so we noted that, and a number of weeks ago said that there could be a pause in the pressure on crude oil prices, and we've had that. It got down to 44 a week and a bit ago, and then, gosh, there's been days where it's rallied up 6% one day and down 4% another day, which is extraordinary volatility for that one. But we think that, and again, looking at previous severe bear markets for crude oil, they don't stop and go straight up as in a V bottom. It can take a couple of months to finally set the bottom on this one. So let's say crude oil trading ranges, big swings, volatility, maybe sideways, maybe to slightly up over the next 6 or 8 weeks, and then it might get itself sorted out where you can have an intermediate rally. This was also part of weaker commodities. The one group that was doing well until 5 or 6 weeks ago were the grains. They got up there and became a little overbought, but what in fact happened is it became vulnerable to the hit in energy prices, and they came down. And it looks like the base metals and the grains, these could stabilize for a bit as crude stabilizes, and you can get some sympathetic rallies. But we're not bullish on the long term on commodities because you're in a post-bubble contraction, and that means commodities generally down. And as we say about the senior currency, that in a post-bubble contraction, the senior currency becomes chronically firm or strong against most commodities and most other currencies for most of the time. So this is it. So the U.S. dollar, of course, was brilliant in rallying up to, I think we got the dollar index got to 95.5, and we had targets of 92 to 94, so it got a little bit overdone. But with commodities stabilizing, possibly going up a little, this will help the Canadian dollar. But again, technical research got it ahead of time because we popped out a piece yesterday showing that on our proprietary model, the decline in the Canadian dollar was severe enough to do downside capitulations in the daily, in the weekly, and in the monthly. So we called it a trifecta because all three are triggered. So it looks like this phase of the bear market against the Canadian has run its course, and we could have some relief for 6 or 8 weeks or something like that, which would be nice.
We'll have more with Bob Hoye right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking with market historian Bob Hoye. What's happening on the stock markets, Bob?
Well, there's a big struggle going on between the bulls, who many of them have to buy stocks, and the bears. And I think I would describe a bear now as someone who is skeptical, as we've been noting actually since June on some of these surges up in the stock market. You're up to sentiment figures like the percent bulls out there and momentum figures that you only see in and around or near a major high in the stock market. And if you look at the New York Stock Exchange Composite, that's the NYA, it looks like it's doing a big rounding top in here. A lot of strength the last week. And we'll watch that one because it's got a good handle on what the whole market's doing. And but, you've had weakness in the bank stocks for the last few months, and particularly in Canadian because of the resource base. These things are bouncing. So I think the best way to sum it up is that we are in technical levels normally seen with a cyclical peak in the stock market. but it's a process and it ain't over yet. So we'll watch now. One thing that has been constructive for the stock market has been the yield curve, which is flattening, and that's the difference between long rates and short rates. And this is now run for, if we say this is now 13 months, and typically a boom or a strong economy with a strong stock market can run, say, 12 to 16 months against a flattening curve. And this worked very well for us back at the top in 2007 and then also at the top in 2000. So we're watching for this one to get overdone and then reverse. And this big setback in the bonds this week could be starting to do something on that one. So then it becomes a warning on the stock market. These weak commodities, it's not a plus because throughout all business history, the good times have been associated with rising prices and the hard times with falling prices. And it's only since the 70s when you went into the senior currency was being depreciated so rapidly with the consumer price inflation up to, what did it get to, 14%, that then rising prices became a concern. So we have to shift our way over into the other side and understand, because the moment crude started to go down in early October, the troops got out onto that one and said, oh, this is great. Gasoline had been coming down since June. That this is going to put more money in the pockets of the consumer and stuff like that. But our view is that falling commodities are indicating weakening business conditions. And if you've got, and also falling commodity prices also indicate pricing problems right through industry. You don't have to be a business that's in commodities, but it reflects pricing problems. So if business is getting very competitive and you haven't got good pricing powers, you don't have good earnings powers, and then you don't have the ability to service debt so well, and then, of course, we've been in a debt bubble, and this could be interesting. And then on to gold, and again, the technicals led some developments. We had that really good rally, and on my colleague Ross Clark's work, it got gold and silver kind of got overbought, and we called for a correction on gold down to somewhere around 1,200 to 1,225. We're sort of in that belt there now. And again, this was done with technical work before the story came out that, you've got now rising interest rates, and that's not so good for gold and all blood storage. But we think that as it's more of an opposite move, where you now have strength in the stock market, you got weakness in gold stocks, and that opposite thing started to come in, I think, back in 2012, where it started to become really noticeable. So, but our view is that gold is in the is building a base. Let's put it this way: the gold sector, gold stocks are building a base for a cyclical bull market, but we're not quite there yet. And our advice back at late November, it was early November, we did a major study, which was to accumulate some of the gold stocks on weaker days, and we're not fully committed yet, and so we got another weakness coming in here. But at the end of it, when this gold really the sector finishes its bottom, one has to have a really good position in it, because what will follow will be a terrific bull market for gold mining and gold mining stocks. So,
Bob, thanks a lot for chatting with us.
Good to be with you, Jim.
My guest has been market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Their website, institutionaladvisors.com. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. Our YouTube channel is Talk Digital Network. You can forward comments about the show to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.